Welcome to Iron Financial. Today, we're strapping on our hard hats and we are digging deep into a financial structure that has the entire market aggressively divided. We're tearing down DoorDash's Q1 2026 financials. Now, at first glance, this company is a towering skyscraper. I mean, we're talking about massive top-line growth, staggering volume, and a global expansion narrative that looks completely unstoppable if you're just viewing it from the street level. But look, we're living in a really precarious macroeconomic climate right now. With interest rates acting as a brutal headwind and consumer spending habits shifting dramatically, you really have to ask yourself, when you build this fast and this high, is the foundation actually solid? Or are we just looking at a house of cards waiting for a strong gust of economic wind to bring the whole shebang down? In this explainer, we aren't just looking at the shiny glass exterior. We're going right down into the basement to inspect the structural concrete. And the real skeptic in me has to figure out if this narrative is pure hype or if it's actually real. I'm looking at this sprawling corporate structure, and all I can see is scaffolding holding it together. Sure, the top line looks absolutely incredible, but at what true cost? Management just bolted on Deliveroo, a massive, incredibly complex European operation. We're talking about integrating completely different logistics networks across really dense European cities, dealing with entirely different labor models than the standard suburban US sprawl. The broader market is cheering this on, but I've got to ask, is that shiny new European addition actually compromising the foundational integrity of the entire building? Are retail investors just completely ignoring the deep structural cracks because the revenue numbers look so pretty on a Tuesday morning press release? Well, that is exactly what we're here to find out, and that's the Iron Financial promise. We're ignoring the corporate PR, we're bypassing the slick management spin, and we're going straight to the blueprints. We are cracking open the raw SEC filings and the income statement, offering you that exclusive insider look that the retail crowd usually completely misses. We need to drill down deep into the Q1 2026 numbers to see if this company is actually forging a stronger portfolio for its investors, or if it's quietly bleeding out from the heavy lifting of this massive global expansion. Let's start with the sheer scale of the operation, because the volume they are pushing through this platform is literally nothing short of historic. The top floor of this structure is absolutely gleaming. We're looking at a top-line revenue of $4.036 billion for a single quarter. This represents a staggering 33% year-over-year jump. Now, let's put that into perspective for a second. Seeing a 33% growth rate for a scrappy little startup is one thing, but achieving a third more revenue year-over-year at a multi-billion-dollar scale, that is incredibly rare. It projects this aura of absolute invincibility to the street. It acts like a massive steel beam supporting the bullish narrative, telling the market that consumer demand is aggressively expanding, regardless of whatever the macro environment is doing. But as we know here at Iron Financial, revenue is just the penthouse suite. We have to look down the elevator shaft to see what's actually holding it up. And what's holding it up is raw, unadulterated volume. The physical reality of this operation is almost hard to comprehend. We are talking about 933 million total orders in Q1 alone. That is a 27% growth rate in the sheer number of transactions. Just imagine the actual logistics for a minute. Millions of cars, bikes, and couriers physically moving bags of food and retail goods across cities every single day. And the Marketplace gross order value, or GOV, that metric surged 37% year-over-year to $31.6 billion. $31.6 billion of capital changing hands on their platform in just 3 months. The Deliveroo acquisition has undeniably supersized their footprint, laying down a massive concrete slab of global market share. Okay, hold on. Stop the pour. This is where the structural integrity completely fails for me, and I have to throw a massive wrench in the gears. If they're pushing $31.6 billion in gross order value, and their total revenue is up 33%, how in the world does GAAP net income drop? I mean, I'm looking right at the filings, and GAAP net income attributable to common stockholders slipped 5% down to $184 million. No way. You're telling me they moved the equivalent of the GDP of a small country in food and groceries, processed nearly 1 billion individual orders, and their actual take-home profit shrank compared to last year? This right here is the core paradox of this entire explainer. Where is the friction? Where is the heat loss in this economic engine? That is the multi-million-dollar question. To find that massive friction, we have to meticulously walk line by line through the income statement and literally reconstruct the P&L. We start with that gleaming $4.036 billion in revenue. But the heavy lifting required to actually generate those dollars is intensely expensive in the gig economy. The cost of revenue, which, by the way, excludes depreciation and amortization, came in at a massive $1.992 billion. That's the raw, unavoidable cost of the materials. We're talking about Dasher payouts, commercial insurance policies, massive server cloud costs, and all those credit card processing fees. The extreme friction of physical logistics eats up half the revenue immediately. They generated $1.944 billion in GAAP gross profit, but the margins are bleeding severely further down the statement, and a lot of that bleed leads right back across the Atlantic. Let's talk about the Deliveroo drag. When DoorDash acquired Deliveroo, they didn't just buy a shiny new revenue stream. They bought a structurally different and frankly much tougher European business model. The European gig economy relies on entirely different courier dynamics, faces intense regulatory scrutiny, and historically operates on much lower margin thresholds. Because of this, we're seeing three major stress fractures in the Q1 data. First, take rate compression. DoorDash is keeping a much smaller slice of the total pie. Second, an explosion in amortization, which spiked 77% year over year. And third, sinking contribution margins. Now, these are not minor cosmetic dents. These are load-bearing issues that fundamentally alter the profitability profile of the newly combined global entity. Let's clearly define this for a second, because take rate compression sounds like typical Wall Street jargon, but it's arguably the most critical metric in the entire building. Net revenue margin is basically the percentage of the order value DoorDash actually gets to keep after paying the drivers, the restaurants, and doing all the heavy lifting. And right now, that margin has compressed down to 12.8%. That is a 5-quarter low. Let me tell you, a falling margin in a high-growth environment is incredibly dangerous because it means you were paying more for every single transaction. So you're telling me they bolted on Deliveroo, and Deliveroo's structurally lower metrics are dragging the entire company's operational efficiency straight downward? Absolutely. The hard data absolutely confirms the skepticism here. Let's do the math for everyone watching so we can see the real-world impact. In Q1 of 2025, the net revenue margin was 13.1%. Now it's 12.8%. A drop of 0.3% might sound like pennies, right? It's just 30 basis points. But when you apply that drop to $31.6 billion of gross order value, that fraction of a percent represents nearly $95 million in potential profit just evaporating from the bottom line. Furthermore, let's look at contribution profit, which is what's left after subtracting the variable delivery costs. Contribution profit as a percentage of GOV has completely stalled out at 4.4%, falling for 2 consecutive quarters. The top-line skyscraper keeps getting taller, but the profit floors are getting alarmingly thinner. Now, I want to see the raw operating costs driving this. Show me the receipts, because if margins are compressing this much, management must be spending an absolute fortune to keep this massive structure upright. And, well, they are indeed. The operating expenses are immense. Research and development cost them $398 million this quarter alone. General and administrative expenses hit $432 million. But then there is the massive non-cash burden. Depreciation and amortization skyrocketed to $267 million. Let me explain what that is. A massive chunk of that is the amortization of the intangible assets they acquired with Deliveroo, things like the premium they paid for the brand value and acquired technology. They have to slowly write those costs off over time, running straight through the P&L. It acts as an invisible weight, constantly dragging down the GAAP earnings. Now, management obviously knows this P&L looks rough, so they're going to confidently point you away from GAAP net income and direct your attention to adjusted EBITDA. Wall Street loves adjusted EBITDA because it strips out a lot of those non-cash integration costs and effectively hides the mess under the rug. And admittedly, total adjusted EBITDA grew an impressive 28% to $754 million, which proves they have incredible scale. But even here, underneath the adjusted spin, there's an undeniable structural weakness. The adjusted EBITDA margin, which measures the actual efficiency of that cash generation relative to the total Marketplace GOV, slipped from 2.6% down to 2.4%. So even when management adjusts the numbers to look as incredibly favorable as possible, the actual structural efficiency is still bending under the heavy weight. Right, and here's exactly how management spins it. They claim they are, quote, investing in our people and products in order to generate better outcomes. That sounds noble on an earnings call, doesn't it? But when you look at the 2026 outlook, they're expecting $1.3 to $1.4 billion in stock-based compensation. Billion with a B. Let me explain what this actually means for the everyday investor listening right now. When management issues over $1 billion in new stock to compensate their employees, they are directly diluting your ownership. Your slice of the profit pie gets permanently smaller. Between the dilution and the $1.1 to $1.2 billion in depreciation and amortization expected, is this really investing in the product? Or is this just massive shareholder dilution masking a real, fundamental margin bleed? That is a critical question. And to answer it, we have to pivot our teardown from the income statement over to the balance sheet. Look, an income statement tells you the current weather. It tells you if it's raining today. But the balance sheet tells you the climate. It tells you if the structure can actually endure a prolonged macroeconomic winter. We need to stress test DoorDash's actual liquidity right now to see if they possess the concrete necessary to support this highly aggressive, high-cost, high-dilution expansion strategy. Let's look at the cash. And this is exactly where DoorDash flexes its serious financial muscle. They have what we at Iron Financial call fortress assets. At the end of Q1 2026, they are sitting on a massive combined stockpile of $4.98 billion in cash, cash equivalents, and restricted cash. That is an incredibly solid foundation. Having $5 billion in liquidity allows DoorDash to do things smaller rivals simply cannot do. It means they can fund expensive marketing blitzes, they can completely suffocate competitors in localized price wars, and they have a massive capital cushion to absorb the ongoing shocks of the Deliveroo integration. Basically, they can afford to outlast the competition. Okay, $4.98 billion in cash is fantastic, but we absolutely have to look at the other side of the ledger. You can't look at the assets without inspecting the load-bearing debt. They currently carry $2.75 billion in convertible senior notes due in 2030. Now let me explain the mechanics of a 0% convertible note. Wall Street does not lend money for free, folks. Lenders accept a 0% interest rate because they get the option to convert that debt into actual equity if the stock price pops. It's a brilliant piece of financial engineering for short-term cash flow, but it ties directly back to our dilution risk. That debt eventually has to be dealt with, and if those notes convert, the everyday shareholder's slice of the pie shrinks yet again. Precisely, which brings us to how management is actively deploying its ongoing cash generation to manage that exact dilution. In Q1, DoorDash generated a very healthy $420 million in free cash flow. That is the hard cash left over after capital expenditures. But look closely at what they're doing with it. Year-to-date, through May 5th, they repurchased 1.4 million shares for $205 million, pulling from a $5 billion authorization for buybacks. But remember, they're projecting up to $1.4 billion in stock-based compensation. This means they are essentially running on a treadmill. Buying back $205 million in stock while issuing over $1 billion means they aren't actually returning capital to shareholders. They're just trying to stop the bleeding. They're frantically patching a gaping hole in the drywall. So looking closely at the blueprints for next quarter, what exactly are we expecting? Can they finally fix these margins? Well, the Q2 2026 guidance is a chaotic mix of brute force volume growth and intense integration friction. They're projecting a massive $32.4 billion to $33.4 billion in Marketplace GOV. They're targeting $770 million to $870 million in adjusted EBITDA. But look at the new headwinds. They're facing over $50 million in gross Dasher gas relief costs in Q2 alone. This proves just how vulnerable this company's concrete foundation is to macroeconomic winds. If oil prices spike halfway across the world, DoorDash takes a $50 million hit straight to the chin. The variable costs can spike at any moment, and the ongoing Deliveroo integration presents continuous, highly expensive operational risks. It's time for the iron verdict. After inspecting the blueprints, is DoorDash a structural marvel or a dangerous value trap? Well, the verdict is highly nuanced. The incredible 33% top-line growth and the undeniable $4.98 billion liquidity fortress prove this is absolutely not a fragile house of cards. It is a genuine, heavily reinforced skyscraper dominating the delivery logistics sector. The $420 million in free cash flow shows strong underlying cash generation. However, the core paradox remains. They are moving $31 billion in product, but watching their GAAP net income shrink by 5%. The Deliveroo integration is a massive structural drag, the margin compression is severe, and the staggering stock-based compensation dilution represents real, load-bearing cracks. It's an incredibly powerful company, but the cost of maintaining this skyscraper's growth is becoming dangerously expensive. And that is the ultimate question for everyone watching. You've seen the raw blueprints, you've seen the undeniably massive revenue growth, but you have also seen the bleeding margins, the heavy debt load, and the relentless shareholder dilution. So we ask you, based on this deep dive teardown, are you actively positioning your portfolio to ride the elevator to the top of the skyscraper? Or are you staying safely on the ground floor, waiting for the compounding structural cost to trigger a massive collapse? Take a hard look at your positions, cut through the market weakness, and forge a stronger portfolio. Be sure to subscribe and stay tuned for the next Iron Financial Explainer, where we'll tear down the next major market mover. See you then.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before